Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be talking about debunking some tax deferral myths.
Yay, everyone's favorite.
So before we dive into it, though, a couple things. We want to put the disclaimer out there. Alex and I are not CPAs, right? We don't file our clients' taxes. What we are, though, is we do help our clients retire, and we help them with income streams and the tax efficiencies of where they've been putting their money. So again, in line with almost every episode I think we've ever done, thinking with the end in mind, that's what today's episode is like, okay, we got to save on taxes in general. Like most people want to do that. Right. And so there's this model out there that a lot of people have that we can go into. And it's not a one size fits all model that we want to explain today.
Not at all. And so much of this is just again, it's not tax advice, it's tax insight and tax strategy.
So, and then the second part is it's called Beer and Money for a reason. So Alex, what are you drinking today?
Love it. Oktoberfest, keep it simple, German original. This is just an old classic.
I don't probably be released after Oktoberfest, but if you're listening to this, we drank it during Oktoberfest.
Yes. I'm not sure the recipe has changed for this for a very, very long time.
Yeah. I'm drinking Icicle Brewing in Leavenworth. So I guess it's kind of Oktoberfest because Leavenworth is a very Bavarian theme town. It's our hazy IPA. So it's one of my favorites that they have up there. So hazy IPA out of Icicle Brewing Company in Leavenworth. So cheers, Alex.
Cheers, man.
All right. So let's dive into it. So let's just set the stage here, Alex. So tax deferred model. Let's explain that just to make sure everyone that's listening is aware of what we're talking about here, because you and I'd like to speak jargon, right, in finances.
And so many people say, Ryan, I'm going to be in a lower tax environment when I retire than when I'm working. And what we would say is, okay, when? And 9 times out of 10, when we ask that question of a client or even of a CPA, they look at us like, what do you mean? And the question becomes, okay, at what point during your working years do you cross the threshold of the income level that you're going to be at in retirement with your working income? Because, and to put this very simply, when you're 22 and first out of college and you're only making like an entry level position, you're still probably going to be below what your income level is in retirement. So the question becomes, at what point in your growth of your trajectory of your income for your career do you cross over and start paying more in taxes during your working years than during your retirement years?
And this is a key piece to think about, because I think so often, we're not, people read stuff on the media, right? And a lot of stuff that's out there is like, hey, you should put everything into like a traditional 401k or traditional IRA, which is pre-tax dollars, meaning you don't pay taxes on the dollars today. It grows tax deferred, and then you pay taxes when you pull the money out. And to Alex's point, this model is based off of you being a lower tax bracket in retirement. Maybe that's the case. Maybe that's not the case. That's the point of today's episode. So let's kind of dive into it here, Alex. So we're going to start with showing
the answer, by the way, will surprise you.
Yes. So I was going to say something else in regards to what we hear people say all the time. But it's surprising when we look at this, because again, when we think about money and we think about incomes and whatnot, I don't think we ever look at it from a standpoint of like, we're looking at a 45-year period of time here, right? This is your classic 30-year period of working years. And then year 31 to year 45, I apologize, is your retirement income years. And so the train of thought is this: like, if you're making $100,000 in year one of your working years, and it goes up by 4% inflationary type number.
Hypothetically, this person is 35. They're working until 65. Like, this is what a linear progression will be over time. nobody is on a linear progression. That doesn't exist, but it's designed to give us an idea as to what happens over time.
So we started the second year of work, we're making a 104, right? So that's that 4% bump every year. As we move through time here, right? 20 years in, we're making 219. Year 23 of working, we're making 246. When we get to the year before we retire, our income that year is $324,000. Okay. And as we retire, right, in our working years, ideally we're saving money, right? And so if we're saving money and we retire, we no longer need to save money in theory, right? So that's why our first year of retirement, we don't need as much money. So we took a $75,000 pay cut in this example.
Now, how many people want to take a $75,000 pay cut?
Well, they were saving that money, right? So that's their thoughts in this example. So Alex is bringing a point of like, if you could keep making that 324 in retirement, would you want it? Right? In the traditional way of looking at this is we don't want to save any money, or we no longer need to save any money. So our income that we need to live the lifestyle that we're accustomed to the year before we retire is 259.
This is a little over a 20% pay cut, just so that we're aware.
Which aligns in theory, because in theory you should be saving 20% of your income. So it aligns with everything that we've always spoken about, right? In terms of how much we should be saving. If we're no longer needing to save that money, well, then that's the money that if we subtract out savings, that's the money we need to live the current lifestyle that we're accustomed to.
And for anybody worried that we're only projecting 15 years in retirement, we cut it off at some point because the point remains the same. We just wanted to show a drop in income at retirement and then that growing back over time.
And what's really interesting is, as Alex and I were building this out, if we look at year 45, right? So this is 15 years into retirement, our income to have the same lifestyle that we've been accustomed to is above the income that we had the year before we were retired.
And yes, with inflation, there might be some we may or may not be in a different tax bracket. We may or may not have seen legislation over that 15 years that changes the tax brackets around. This is all stuff that falls into the category of unknown unknowables. And we have no way of knowing for sure what's going to happen over that 15-year time period.
100%.
Which is also 30 years in the future for this person.
So let's analyze this now. So let's go to the taxes, and now we're going to work with married filing jointly. This is a married couple, right? We're going to go ultra stereotype here. We started with a 35-year-old retiring at age 65. Like, we're going ultra stereotype here, right? So 324 is their income the last year that they're working. So let's analyze this. If 324 is their income, so we're putting in our tax charts for those of you who are not watching the video.
Right.
We're now
just so you're aware, I still see the other calculator.
Let me now switch then. Bear with me here. So, all right. So now we're looking at $324,000 of income. If that's all taxable, now we're not worried about standard deduction. We're just, again, this is concept to understand taxes, right? Our taxable taxes that we would pay is we're in the 24% marginal tax bracket. We paid a total of almost $64,000 in taxes, and our effective tax rate is almost 20%, 19.71%. Okay, so that was our pre-retirement taxes. Now, when we get into retirement, right, what that broke down to was our first year was 259 was the number, right? So over here in scenario 2, we're doing 259. And let's look.
Do it as 250.
Sure. Make this really simple. So we go down to 250. We're hit calculate, right? So what's interesting about this is we're still in the 24% marginal tax bracket. We did pay a lot less in taxes, $46,000. We obviously didn't take as much, right? 250 compared to 324. Right. And our effective tax rate is 18.43%. So we didn't technically go into a lower tax bracket in this example. And the question that we want to bring up is, and let's just say we did. Let's just say we dropped down to 22%. The question is could we have done better if we actually managed our taxes a little bit more efficiently? This is your classic. If we're taking 250 for income in retirement, this is your classic pulling all of that money out of a tax deferred account. So we have to pay taxes on every dollar we pull out. That's what this is. That's what retirement is for this person. What if we could do some version of this where 250 is still the number we're pulling out? Because again, that's just the number we need on lifestyle. But what if we could do only 150,000 of that is taxable? Now it drastically changes it. Now our effective tax rate is 9%. That's a 60. No, effective tax rate. That's a 53% difference.
Right. Change the left-hand column. Instead of 324, make that 250 and 250 so that we're comparing.
Oh, sure.
We're comparing traditional model of everything being taxable to a model where not everything is taxable. And there's multiple different ways that we can go ahead and create cash flow without it being taxable.
So as you look at this, it's still pretty much a 50% different in taxes.
Yeah.
Right. And it goes back to, like, as we just, I'm going to draw it out, and because I don't want to keep shutting down screens, Alex, I'm just going to draw it on this screen.
Sure.
It goes back to this. So often, like, if this is our income, right? That linear chart that we showed earlier, and your income's going up. So often we think, okay, if this is our last year of retirement, when we get to or last year of working, when we get to retirement, we're going to come down here, and this will be our income that we need for retirement, and in theory, be in a lower tax bracket. And we're asking the question, well, what if you could be down here in the tax bracket, as long as you managed where you were putting money and you had strategy and efficiencies in turning on the income stream?
And so what people are saying is that top circle, and Ryan, throw a 1 next to that. People are measuring the difference between that and then measure the first retirement, or put a 2 next to the first retirement one. They're measuring that difference and saying, we would be better off taking a tax deduction the last, like, however many years we are above our income level in retirement. However, put a 3 next to the lower one. No one is measuring the delta or the difference between 2 and 3, which that is what is the difference in taxes due, because we were able to go ahead and create either partially taxable or tax-free dollars in retirement. Nobody is measuring that delta. And as a result, we don't know definitively whether it's a good idea or a bad idea to defer taxes in those last few years of retirement. But if you draw a linear line over from 2 to our income during working years, we can fairly definitively say that every year below that level, we're going to be better off using Roth as opposed to traditional. We're going to be better off not taking the tax deduction, but using other methodologies to grow our dollars. In an ideal world, it's Roth or it's tax-free on the back end, but maybe we wind up creating some dollars that are potentially partially taxable, where we've got more access to it, we've got more liquidity, which by itself adds some amount of value, and then we have potentially some better tax distribution structures, and we wind up trading fully taxable as ordinary income for taxable as capital gains. So there might be a delta there. When we take a look at taxes, these are the different types of things we need to take a look at. And we want to make sure that we're measuring the right things, not just looking at where are taxes at, where do we think that taxes are, where our income is going to be based on our current tax bracket, let alone where do we think taxes are going to go, what type of strategy do we have. And quite honestly, one of the things that Ryan and I take a ton of look at is trying to create flexibility. Like virtually all of our clients wind up getting to retirement with some dollars that are fully taxable upon distribution because they're in traditional 401ks or IRAs or things of that nature. So that's not usually a concern. The concern is, do we have any dollars that are in potentially partially taxable or potentially tax-free sources that we can then use to mitigate or modify how things look if things don't work out the way we want to? Having some amount of balance, and balance does not mean equal, but having some amount of balance between tax deductible, tax free, and potentially partially taxable methods of distribution in retirement is a really good idea.
Yeah, this is not a beat up, even though it's sounding like it's a beat up session on the tax deferred model. That's not the point of this. Is the point of this is to understand this myth out there that everyone it will be in a lower tax bracket in retirement. That's myth number one, because that may or may not be the case. And myth number two is understanding that you can actually control the tax brackets to some degree, as long as, to Alex's point, you have balance in where you've been putting dollars. Our next episode, because I'm sure some of you watching this are saying, okay, I understand what you're saying, Ryan and Alex, but in that second scenario, you're talking about a gross cash flow of 250, but only paying taxes on 150 of it. How do you do that? Well, that's our next episode. We're going to go through at least one of the strategies, possibly two, depending on time. But we will make sure we get into that in our next episode. So, Mr. Collins, we didn't discuss this, but I'm going to throw it at you ad hoc here. What question of the day do we have for everyone here?
The question today is, how have you designed your retirement plan? Is it all traditional? Everything is tax deferred and will be fully taxable upon distribution? Or do we have some amount of balance? Again, not saying it should be a third, a third, a third, although that's not necessarily a bad balance, of tax deductible, potentially partially taxable, and tax-free sources.
So we hope this episode is valuable for you. Look, if you got anything out of today's episode, right, share it with your friends, share it with your parents, right? Maybe they're the ones in retirement or getting close to retirement, right? Because these are the conversations we're having all of the time. And when we tend to go down this, no one has ever said, Ryan and Alex, this is rocket science. This is actually just common sense once you understand how the tax brackets work.
And so much of it is just trying to put some amount of intentionality and thought and then math and science to looking at your specific situation.
If you're driving in your car and you didn't get to see the screen, the video side of this, I think that it is a huge piece of understanding this. So head over to beerandmoney.net. And if you go to the podcast episode titled Debunking Tax Deferral Myths, you'll be able to watch this video and hopefully get some valuable information out of it. Contact us. Meaning at the top, if you got questions from this, like, we want to hear them so we can help answer those questions. Or if you're like, wow, I didn't know you could do this. I don't know how to do it for my personal situation. That's a great way to contact us to see, does it make sense for you and I, or you and us to discuss working together. We hope this episode was valuable for you. And as always, Mr. Collins.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806. Number 7223543.1. Expiration October 2026.